SUI is unique in its settlement finality is so short, so it suits itself to these high velocity things. It's incredibly inexpensive, so that's great too. There is liquidity and all the other things, but really SUI was built for these big Web 2 applications to turn them into Web 3. The formula for GDP and how economies work is basically population growth plus productivity growth plus debt growth. We have been in a slowing economic world because of aging populations, and we've offset that by debt. Now, we're in a death spiral until something changes. So we just keep refinancing the debt and hoping it goes away, and we don't get enough growth. So then the debt keeps going up, debt to GDP keeps going up. And eventually you're about to throw in infinite new workers into the system. Which is AI and robots. So then suddenly GDP growth can go to 20% a year globally. Who does that accrue to? How does it accrue? What does it mean for us? What does it mean for our jobs? When AI comes, it makes a lot of work. Even me in my macro research, or even me online, because I can use AI. I'm already using AI. You know, people don't understand the whole scale disruption of what is coming. So how do we become economic participants in the new system? Well, blockchain shows some of the way of that, because you can participate in a network by owning a token. If the network gets used a lot, you make money from that network. If you work for that network, you're giving your attention, you might get some tokens, which was the idea that Brave tested.
That's right.
Okay, very good test, interesting test.
Raoul Pal, founder of Real Vision, maintains a long-term bullish outlook for SUI. He predicts the token could be a top 5 buy by 2025. Paul expects SUI to consolidate below $3.50 before a potential bullish breakout if Bitcoin reaches new all-time highs. He believes SUI will outperform once Bitcoin reaches new highs. However, SUI has underperformed Solana by 26% since May 2025. The SUI-Solana ratio shows that SUI has lagged its main competitor in recent months. By the end of April, SUI outperformed Solana by 56%. Since then, the performance gap has reversed, favoring Solana holders over SUI investors. The SUI-Solana ratio is currently testing critical support at 0.0158. If this level holds, traders could experience another 50% spike in relative performance. May saw record DEX volume of $14.12 billion, coinciding with SUI's peak price of $4.20. Strong DeFi activity has boosted demand for SUI tokens used for transaction fees. June marked a slowdown in DeFi activity, with DEX volume dropping 50% to $7 billion. This drop coincided with SUI's price falling from over $4 to $2.20. Despite the recent decline, technical analysis suggests that SUI is approaching the top of a symmetrical triangle pattern. This formation typically precedes breakout moves in either direction. According to Raoul Pal, this is why SUI has more upside potential than Solana. Before we move forward, if you want to stay updated with the latest crypto events and news, you can subscribe to our channel and like this video. Now, let's get back to Raoul Pal's view on Solana and the overall crypto market.
Well, this is an inverse model to anything we've seen before. So retail drove the thing from start, which was fascinating. And then the financial system. I've always said, and I've been saying for a decade, we can front run the institutions. And we had basically 10 years to front run them. And they're coming in the financial sector first. So stable coins, it's a way of the US broadening its reach of the dollar, but it's also a way of financing the debt, which is a huge problem. It still remains the biggest economic problem to date. And then on top of it, blockchain rails are just more efficient for settlement, instantaneous ownership. This decentralized ledger is extremely useful for the financial system. Things like NFTs work really well for things like derivatives, because those are just contracts and we can turn them into smart contracts. So the next 5-10 years will be all of that moving to blockchain rails.
Paul sees strong similarities between the current cryptocurrency cycle and the 2017 rally. He points to a combination of macroeconomic signals and the current Bitcoin price trend that he believes are setting the stage for another major rally. If this situation continues, Paul believes this rally could accelerate dramatically and even extend into 2026. Much of his analysis is based on his own business cycle model, which shows that the global economy is still in its early stages. This phase of the cycle typically coincides with rising asset prices, especially for riskier investments like cryptocurrencies. Paul also points to increased global liquidity driven by continued support from central banks and the postponement of rate cuts. He believes this combination of factors paves the way for what he calls the banana zone, a phase of high market activity where prices can skyrocket, mirroring the parabolic moves he's seen in previous bull cycles. One important difference this time around is the growing participation in sovereign wealth funds and large institutions. While many analysts are already anticipating a market top, Paul isn't rushing into it. He remains level-headed but leans toward optimism, stating that the current situation is more like early 2020 than the final stretch of a boom and bust cycle. He believes there is still plenty of room for solid growth before things get tough. Paul remains realistic. Sharp pullbacks are a normal part of how this market works. The swings can be sharp, to be sure, but anyone familiar with the industry knows this is nothing new. What Paul really means is that cryptocurrencies have matured. They're beginning to adapt to reality, the money supply, interest rates, and government response to the markets. This progress is significant. If the current situation continues, cryptocurrencies could become deeply integrated into the system next year. Institutional capital is flowing in, adoption is growing quietly, and the dynamics are different this time. Paul presents what he considers the two most important charts in all of macro. An aging population forces governments to borrow more to boost gross domestic product, GDP growth, and pay interest on their debt. Paul's first chart compares the labor force participation rate in the United States with an inverted graph of U.S. government debt as a percentage of GDP. The second chart compares the U.S. Federal Reserve's net liquidity with a normal graph of U.S. government debt as a percentage of GDP. Paul argues that these charts highlight a serious macroeconomic challenge, the ultimate result of which will be currency depreciation. With debt exceeding 100% of GDP, economic cash flows are insufficient to finance the growth of debt. Therefore, debt is printed through the Federal Reserve's net liquidity and through regulation, is incorporated into banks' balance sheets. This depreciates the currency and reduces its denominator, thereby increasing the value of scarce assets. Cryptocurrencies, primarily Bitcoin, are a lifeline, as they not only offset the 8% annual depreciation, but also appreciate in value thanks to their adoption. In the long term, Paul believes that artificial intelligence and robotics will improve the situation and play a key role in alleviating the pressures of an aging population. Raoul Pal claims that NFTs are the best long-term store of wealth. Paul's comment, captured by the community, reads, "You don't own enough crypto, and if you do, you don't own enough NFTs, because art is the source of wealth. But both will never be this cheap again." Influencer Lark Davis agreed with Paul, admitting to owning few NFTs and intending to change the situation. Paul responded by suggesting buy a punk to start, referring to CryptoPunks, one of the oldest and most recognizable Ethereum-based NFT collections. Paul's followers claim he has often been ahead of his time, pointing to his previous interventions on macroeconomic trends such as the institutional adoption of Bitcoin and the rise of Web3. For them, NFTs, especially those tied to cultural provenance, represent digital ownership in its most ancient and underappreciated form. He suggests that digital art could be the best long-term store of value due to its unique properties.